Hello and welcome to the Investor Master Series. My name is James Boyd. Happy Tuesday morning to you. My wife said I was not allowed to wear the green shirt. She said it wouldn't look good. So I refused to wear the red shirt, but maybe I'll crack that bad boy out tomorrow, that green shirt again, and try to get those bulls to have a little confidence near these support levels. We'll talk about that in just a moment, but I did see a lot of your jokes in the chat. Now, trust me, if it was up to me, I'd be wearing that green shirt solid. All right, but I have to settle the peace around here. Now, also remember that when we talk about this class just talks about stocks, fundamental analysis, technical analysis, macro analysis, which has kind of been a main theme lately. We'll also bring up inner market analysis, where we talk about relationships of different asset classes. And also remember, we also bring up options. Now, also, remember when we talk about options, if we bring that up, remember that options carry a high level of risk, not suitable for all investors. The information provided here is for general informational purposes only. This webcast discusses technical analysis, which is a main theme, of course, but there's other approaches, okay? So that's important for you to understand. It's not just technical analysis. There could be other things that are going on that cause those prices or trends or momentum to change. Be aware of that. We'll bring it up here today. And we're going to do it in layman's term, okay? Not super complicated, but try to regular Jane or Joe, how do we actually understand what's going on with current markets? Also, Paper Money software application, we'll use that for our paper trading account. Remember that investing involves risk, including loss of principal. And also, when we talk about involving risk, want to understand the differences between the right to sell or puts versus setting a stop. A defined risk versus theoretical or planned risk, okay? Now, also remember when we talk about examples, they are just that. When we also talk about short options, those can be assigned at any time up to the expiration, regardless of the in-the-money amount. Now, I want to kind of talk about these market conditions that we're seeing, kind of some noteworthy changes in price levels. We'll talk about the SPX to begin, and we'll kind of talk about how what we're seeing in equity markets are kind of causing things to change or be hit by what's happening in rates, currencies, volatility, and also commodities. We'll talk about kind of those sectors just briefly. Then, of course, we need to bring up some current positions. With such big moves in the market, what about managing current positions? Got a number of positions I want to take a look at, and then we'll talk about some new examples. So first off, let's start with just real quick the SPX. Notice anything different here today? Well, if we zoom in, we had been holding that 58.62. We got down below that. And matter of fact, it actually closed, we're trading at the lowest price level that we've actually been trading at since November, okay? So when you take a look at this, and I want to kind of go down to the bottom and kind of take that conversation going forward from yesterday, we talked about kind of oversold indicators, like looking at a stochastics. I talked about a 7.3 stochastics. For this morning purposes, to show some differences, I'm looking at 14.3 stochastics, and you're going to kind of see that we're in that lower end. Now, when the stochastics gets in the lower end, it's normally ugly out there. That's why it's actually in the lower end, okay? Now, kind of another example, when you look at the RSI, we haven't even gotten to the oversold area yet. My comment on the RSI versus the stochastics, RSI is kind of extreme oversold, extreme overbought. Where on it, and it's not as practical for a day-to-day purpose as the stochastics is, okay? So I just want to kind of show that we're still down in this range, and when we're down in that oversold range, the volatility tends to be sky high, okay? Matter of fact, you might even get a phone call from a friend where the friend says, what do you think about this market? And you say to your friend, well, why does it matter? And their friend says, because I don't have stops in my positions, I'm over positions. What do you think I should do? Okay, that's usually what happens right about right now. So if you get those calls, you know we could be close to that tradable bottom. Now, when you look at this kind of these lower ends, below where this 58.62 is, it's 5,700, okay? So zoom in just real quick and let's try to make simple sense, okay? Now, remember, we kind of always said is if we get the 10-period moving average to be red, we have negative momentum. When we have the 20-period moving average red, we have negative trend. This is not just something today. This has been something that has been going on the SPX for the last couple days, okay? So what you're going to notice is if we get the red lines on the moving averages, where do you think the price is going to go? Where do you think it's going to go? And that's an important question for me to ask you because we have to admit it. I could see it on the chart, but it's hard for us to verbalize and admit it. Because if I admit it, then I'm cognitively starting to understand, oh yeah, I'm not just looking at the technicals, I'm reading them, and what do we think is going to happen? Well, so far, we're still below the moving averages. When we've actually gone up, we went up for one day and then sold off again. What does that tell us about momentum? Still negative. You can only go up for less than 3 days before those sellers come in and smash it down again. There are still more sellers than buyers, hence the price being knocked down. Now, I want you to remember this comment that I said, okay? The VIX. Now, I know when we see the VIX at these levels, I know like sometimes I used to be scared, okay? Could you imagine James scared? I was scared, okay? And I was scared because I didn't know really how to protect or anything like that. Didn't know about exits, didn't have any of this stuff. And so if you look at this, we're going to kind of see that the VIX is kind of now starting to get somewhere. If we go back to July, we have not seen the VIX at these levels, 25.94 to be exact, where I'm pointing at. And what you're now going to notice is it's the exact opposite of what we saw in the S&P. The S&P was actually oversold. We're actually starting to get to the point where really the VIX is really getting near the overbought area. Now, if you pull this back up and say, well, how long does it tend to get overbought for? Guys and gals, it's the flip of the discussion yesterday. If it tends to get overbought, it doesn't get overbought very, very, very long. Why is that? Well, because when the price goes higher, the value or the premiums for the put, are they higher or lower? Well, if the VIX is higher, the puts would be typically higher as well. Okay, that's the true answer. Correct. Now, if the puts are higher, how many people like to buy more expensive puts? Unsure. That's correct. A lot of people say, you know what? I don't want to buy those puts. They're just too expensive. Okay? Because the higher the put is, in terms of if you buy it, the higher the stock has to go up to break even. The higher the time decay, the greater the risk to implied volatility. Okay? So all I'm going to say here is, remember that I said this, the higher the VIX goes, the more interesting it becomes for bullish investors. Now, that does not mean everything, but when the investor kind of sees that we're in this condition where we have high VIX, they're probably thinking about how might that investor maybe do an index-based trade. Wait, why did you just say index? Did anybody know why I just said index? That was planned. That was not just kind of put a word in there. Well, because if the investor said, I'm going to do an index-based trade, maybe on something that tracks the index, okay, maybe like a stock, a product that tracks the index, and or the index itself, maybe like SPX, short put vertical, long call vertical on the SPX, because they're buying a group of stocks. They're not buying individual stocks. So it's a greater chance that the index could bounce back versus you picking or me picking an individual stock that could go up. So some investors that have experience, they say, look, I'm going to try to maybe put an index-based trade on. We'll do that. And then after that, maybe look for some individual stocks that might be showing that strength. Sure. Okay. So the first step that we want to do here is in this first part of the discussion, we're going to go to the SPX. Now, I'm going to tell you right now, I just want to be 100% clear. Crystal, if we could, we use a different product. Okay. On Friday, I teach a class on ETFs. We know that there's an ETF product that actually tracks what's supposed to be the S&P 500, okay? I can't do that in this class. So I'm going to use the cash index. So when I say the cash index, the S&P 500 index, there's no underlying shares, okay? There's no underlying shares, okay? And so what we're going to do is going to go to the trade tab, and we're going to go to the April expiration. Now, this is very important here, okay? Do you think it's better off if we go shorter term to expiration? Medium? A little longer? Well, a lot of people would say, James, I don't know if the market's going to turn around the next week or two. Maybe I want to go a little bit farther out, okay? So why are we picking the SPX? Well, we're picking the SPX because we think there's a greater statistical chance the SPX could bounce back up versus an individual stock, okay? Now, number two, we're going to come over here to the put side. And if we come over here to the put side, on this product, we need to be a little careful because some of these spreads are wider than others, and some of them don't have the same liquidity. Now, what I'm going to do is I'm going to go down and kind of look at the strikes, and I'm just going to kind of take a look at which ones kind of have some open interest and volume. Now, if we chose the 5,600, okay, the 5,600, you're going to see that there has been some volume there and open interest. We're going to sell the 5,600s. Now, the one thing we need to understand here is if we sell the put, there's no underlying shares. So this is what's called cash settled. What does that mean? Well, you either have a profit or a loss. You're not getting assigned shares because there are no assigned shares. It's a profit or loss. What we're going to do is we're going to right click on that 5,600. Trade number one. We're going to kind of say, okay, S&P 500 in that oversold condition so far, could it go lower? Yes. We're just kind of saying statistically, also where the VIX is, kind of looks a little high as well, okay? And we're going to kind of see if we can't get close to the S&P 500, the index, maybe getting a little bounce here, that doesn't need to go all the way back up, no. But we're also trying to use the higher implied volatility. So you need to understand something is usually if you look at markets where the VIX is, let's say 13, 15 on VIX, you might only get the S&P 500 be at 15, 17 on the implied volatility. But when that VIX is where we are now, we're seeing that implied volatility is higher than normal. Now, what I'm going to do is here, we're going to right click on the 5,600, the bid, going to go to the vertical. Then what we're going to do is going to come down and we're going to widen this out 10 points, okay? And what that's going to give us is really a 280 credit, okay? Let me just bring that back up over here, okay, in the paper money account. And I'm going to come back to this. No worries. There it is. We said the 5,600. So 5,600 and the 5,590. Is that correct? There it is. Okay. Now, I just want to make sure 56. Now, notice on there, it's not a PM expiration. It's an AM expiration on Friday. It's not Friday at the close. Okay. It's Friday in the morning. And also understand that not all stocks open up at the same time. So it might take some time to get a settlement for the S&P 500, okay, which is an AM expiration. So I just want to kind of make sure on this, the 5,600, okay, there. And I want to make sure we got the same. So let's just verify that. I'm in the paid money account, vertical. And now what I'm going to do is going to go to the 5,590. Okay. Now, what you're now going to notice is there's the credit. Now, the one thing we need to kind of understand here is if someone said, James, I want a higher upside, might go the long call vertical, might look to add to that. But first off, we're going to do a short put vertical on the index. This is not a forecast that one stock is going to go up. This is where the investor is forecasting the index is going up or could rebound. If we take a look at this, max profit, max loss. Now, notice something we don't normally see, which is a commission, okay, $1.30, which we've seen, but there's also a fee, and that fee is for the index. We can click on it and say, what's the fee for? And we can see what that is. Those commissions and fees subtract from the credit we receive, and we're going to go ahead and say, send that order, okay? So that's trade number one there, okay? So this is first off, when markets kind of pull back, I think a lot of times investors actually say, I'm going to go look for individual stocks. I think the investor might say, I'm going to go for an index. I'm going to go for a sector to maybe trade or invest in a collection of stocks, but not picking or trying to pick the exact one that bounces to the upside. Now, the one thing we want to kind of bring up here, when we look at kind of some of the things that we're seeing that have been quite bearish, when we've actually seen the market go down, not unusual, crude has gone down. Now, this is not all bad, okay? I don't think anyone says I want to pay more for gas, okay? Crude has gone down. If we also look at, for example, now we could bring up TNX. another way you could do this, TNX CGI, this is the 10-year rate. What have you been noticing? Well, that rate has been declining quite a bit. Is that a positive or negative? Depends what side of the stick you're on, right? So if you take a look at this, you'd say, look, if you're a borrower, things might become a little bit more cheaper potentially to borrow, okay? And so now remember, that might help real estate. It might actually help, in this case, maybe staples, utilities, some healthcare, right? Usually when you're getting that interest rate to drop, that correlation to income sensitive areas. You also have to think about there's some people that do fixed income. And when they see their rates drop on T-bills or corporates or whatever they are, they might say, hey, look, I'm going to go look at maybe some stocks that also might pay a dividend comparable to what they might be getting on the fixed income product, okay? Not a recommendation. Kind of educate yourself on that, see if that's something you would consider. But if you take a look at this, rates have actually gone down quite a bit too. Gold, where's gold gone? Now, with some of that fear, has gold gone back up? Yeah, it has. Is it at the high? No. Is it within 2% of the high? Yes. But on a relative strength basis, has it held up a lot stronger than stocks? And I think we could all say there, yes. Yes, it has. So this is a major point. It's when things pull back, a lot of things pull back. And more, matter of fact, the more the market falls, the greater the correlation. Okay? So what does that mean? It means that even some good areas could be drugged down by the market, but they're not going to be drugged down in the same percentages as you're going to see here in just a second. Now, the one area that I'm watching when I've been sleeping lately, I've been sleeping with one eye open. And that one eye open is on that Japanese yen, okay? Now, I've said this for months, and I'll say it again. The Japanese yen is actually what's part of a carry trade, so they have a cheaper rate of interest. People will actually short this or borrow against it and go long another currency. What can actually happen is if the Japanese yen starts to increase, the carry trade can actually unwind, causing more volatility in asset prices across the board sometimes. If this gets much higher than where we were here today, that actually means that the VIX, might even go higher, okay? And so this is something not to sleep on. This is something to watch and say, if this goes up, what happens with stocks? What happens to the stock market and so on? Where do people put their money? Do they put in gold? Do they continue to put it in some of those sectors that have been a little bit more protective? Now, you guys and gals have maybe not seen that like I have, but that's something to watch. If that actually starts to go up and starts to go up more aggressively, we could actually see more investors maybe shun maybe the US dollar perhaps, and go also with that, they also might want to be more protective. And that's kind of what we've been going through. Now, when we look at the sectors just real quick and just kind of notice the differences here, okay? So it's not all the same. And so if we look at the sectors, what you're now going to notice is when we look at, and I want to look at the week returns for just a moment, then we'll look at the month returns, and then we're going to look at the trend, right? So when we look at, are all things the same? Absolutely not, okay? So when markets are falling, some people tend to hide out in those staples, healthcare, and utilities. And just as we always talk about, there they are again, okay? Now, it's not to say that they're smashing home runs and grand slams, but how many would like to be down 1% or up 0.7% or 1%, 1.7%, et cetera, than being in, let's say, energy, tech, or discretionaries where they're down 5 to 6 in the week, okay? In the week. So what happens here? Well, people are in these income areas. These are companies where those revenues, earnings per share, they can withstand more volatility. A lot of their products, they're more inelastic. If the economy goes down, do I shut my lights off and just use a flashlight? Probably not going to, okay? But these areas like, let's say, discretionary, energy, technology, people can curb their spending to maybe mimic what's happening in the economy if they feel like they need to cut back, okay? So these areas are more elastic. They're going to be at greater risk if there is more volatility in the economy, and that affects, or can affect, could affect, the stock prices. Isn't it completely shocking? It's like a natural reaction when you think about it, okay? Now, what I want to do is I want to see just real quick if there's any questions with what we talked about so far. Now, here's the deal. When we come back to these, okay, so first off, if you're someone that really likes discretionary stocks, and I think many of us do, and likes energy stocks, tech stocks, I'm just going to make this comment. A lot of people do. But when the volatility goes up, a lot of people need to be careful of those areas and be careful about overinvesting just in those areas that tend to be more growth related by themselves. Sometimes it's not about the growth, it's about protection of capital, okay? So when you look at those areas of, let's say, staples and so on, just a couple stocks, and I see these in the chat, when you look at, let's say, Procter & Gamble, that's actually been one that's had a pretty nice push as well, okay? And what you're now going to notice is it's kind of swung back to the upside, and if we go back to this, what you're going to see is on a 3-year weekly, it actually kind of looks like it might even try to break up through the prior high even, okay? So yeah, there's a couple there. And if we look at, let's say, the real estate, $ IXRE to pull up the index, when you pull that up on the daily, yesterday that broke through the channel, still above the channel. When you look at the IXR, okay, staples, that is at the prior high, okay? Now compare that chart to the technology sector. Compare that chart to, let's say, discretionary. It doesn't even look close. Now, when you look at, let's say, utilities, they're not smashing home runs, kind of neutral, but probably rather take a neutral than a negative, many investors might think. And if you take a look at, let's say, what we have on the healthcare is still there, and it actually got above the prior high. So this is a first major theme here. When volatility goes up, people tend to hide in these income areas that are less sensitive to volatility in the economy. It's not that they're not affected, they just tend to not be affected as much, okay? Now, are there any questions here? Yeah, now the other thing actually Gary says is Abby V. My daughter's Abby, so of course, Abby V, okay? If you take a look at Abby V, that did punch a brand new high. Now, we're gonna come to a couple stocks here in that space, but yeah, these are just kind of a couple we've seen. And I think the one that's been a little surprising is Big Johnson, Johnson & Johnson, smashing a brand new high. And if you look at that, big old continuation pattern. So as these investors are fleeing those growth areas, someone's been buying the defensive areas. Not a surprise. Now, let's go back to just real quick, some examples that we need to discuss. So first off, I want to kind of just acclimate ourselves again with so last week we talked about, pull this up. So last week, if you did not know, this class is being recorded. And you could go back and say, hey, could I look at last week's class where we talked about, I pull this up, on exits and option protection. Now, I'm going to tell you, and I tell you this, a lot of people kind of know about protection, but it doesn't mean they do it, okay? There's time where option protection makes more sense, okay? It doesn't always make sense, perhaps. Option protection, what are we talking about? It could be buying puts. It could be collaring a position, like a stock position. It could be a short call vertical, a long put vertical. It could be a short synthetic. Option protection is where you think maybe the market might pull back or the stock might pull back, and you're going to use one of those instruments in the toolbox to protect the portfolio and or stock. Let's start with kind of just a basic example, and we're going to kind of then take the next step up. And the first example I want to kind of take a look at here, and if you have questions, I got to hear them, okay? So what we did is we bought shares of Altria. Why would someone buy shares of anything? They think it's going to go up, or it pays a dividend, or both. Well, if we take a look at this, the stock went up a couple bucks. Okay, now, if we take a look at this, we also, in this case, bought a put. And when you buy the put, you got to pay for it, okay? And what you're now going to notice is that put, the strike, is at 52.50. Now, what do we want the stock to do in relationship to the strike? What do we want it to do? What do we want it to do? We want the stock price at the strike price to get farther and farther and farther away from each other. Why? Well, because we have 100 shares of stock. And if we get the direction right of the stock, we have an unrealized gain. Now, what people don't quite understand is, do we want the put to become valuable? No, we do not want the put to become valuable, okay? And you're going to notice that put has gone from 40 cents down to 8 cents, and it's down 32 cents. Now, so like what I said before, if we would have known the future, which we don't know, we would have known if we knew the future. We didn't need the put, but we don't know the future. Why did we buy the put then? Well, because buying the put was a way to manage the risk and define the risk. When you buy the put, you have a right to sell the shares at the strike price from now until expiration. From the time you bought the put until expiration. Who controls that right? The person that bought it. Now, let me kind of show you something. So right now, since I didn't know the future, and you didn't either, is we have $309. If we knew the future and we just bought the shares by itself, we would have been up $339. Now, my math isn't great, but we got about 90% even though we didn't know the future. Okay, now, I want to go back to something for just a sec, okay? Does this mean we can't sell out? Does this mean we can't just take the gain on the stock and just cash out? Well, let's kind of go back to this. Is this maybe an area that the investor might consider exiting we called it a married put. A married put, if someone said that to me, means you bought the shares and you bought the put at the same time. All right. Now, do you think, and I need to know from you guys, okay, and gals, do you think this is an area where an investor might try to sell at the prior high? Now, there's really two ways we could do this, okay? Number one is we might say, hey, could I just sell, okay, the put itself and then sell the shares? Okay, could do that. The other thing is, if I did that, all I'd have to do is right-click on that, create closing order, and say sell. Okay, sell. And the reason why I'm getting rid of the put is I just want to make sure there's not an outstanding right, that we don't forget about it, and that could morph into potentially short shares, okay, if the stock were to close below that strike price. So what I'm going to do here is I'm going to sell the put. Now, you might say, well, James, this is dumb, because really it's only 8 cents. And if you look at that, you're paying what commission? Well, it's 65 cents. It's really not that the investor probably wants to pay a commission of 65 cents. It's more that the investor just wants to make sure there's no strings still attached. Okay? Credit there, $7.35. Now, the gain there, if we go back, it's not on the put. It's on the shares. Once that actually fills, there it is. We're going to right-click on that, create closing order, and sell the shares of stock. Many times, investors use that prior high as a target price to try to sell into. Now, if we come back and say send that order, there it is. So could you do like a married put? Now, when I say married put, we're talking about buying the shares, buying the protection at the same time. Don't say you don't do that, because I can think of 10 examples off the top of my mind that you do probably all the time. So you do married puts all the time. You just don't relate it, but you do consider it. Now, let's take the next baby step, okay? We know that we've had shares of Amazon. We know that. And what we did is we actually bought the put as well. When does the put become valuable? Ooh. So if you bought the put, what do you want the stock to do? Well, if you bought the put, so let me repeat that. If you bought the shares and you have the put, we talked about we would like the stock to go up because we have a higher delta than the put delta, okay? So that just means that we're positive, we're delta positive. It's a bullish strategy. Now, this is the opposite situation. The stock is below the strike price. Now, on a put, that actually means that you have intrinsic value. You could also think of it as equity. Now, if that stock, if the strike, the long put strike, is at $2.15, and we bought that put for $3.40, and now the put has gone up $17.15. That put has made unrealized gain $1,327, which is kind of offsetting some of the losses we're having on the shares. How many of you wish you could go back and buy a put on some positions? We always feel like that, right? Now, so let's kind of hold this. Now, one thing I do want to point out here that is noteworthy, notice the put delta is getting higher and higher, but in a negative way. What does that really mean? What does that mean if that delta is becoming more and more negative? Well, that actually means that it's actually protecting against more and more of the loss of the shares on the stock. Okay, interesting. Now, if we take a look at this, notice we sold the call again. This is a third call that we've sold. Sold it for $3.75. Now, wait. So when you sell the call, if the stock drops, where does the call value go? Well, the call value tends to decline in value. Why? Because there's a lesser chance of the stock to close above the strike price. Hence, the premiums drop. And they went from $3.75 down to $2.87. Now, you're going to notice that we could grab that $346 right there. Now, in this whole position, if we just did no protection, we would have been down about $3,000. But since we did this protection with what you see here, we're down $1,300. Guys and gals, the first thing you need to understand is how can you lose less? Okay? If you cut your losses in half, do you think you'd be more profitable? Now, this is not showing everything we've done on this trade. I'll show you in just a sec. First thing we're going to do is, what do you think we're going to do with this short call? And guys and gals, I'm going to tell you right now, in your lifetime, you're going to see stocks go down. You want to be very comfortable about buying puts or considering it. You want to be very comfortable as far as doing callers, because one of the main jobs of the investor is not to see how much money you can make. The main job of the investors is to protect the capital. After the protect the capital, then we'll talk about upside. Okay? What we're going to do on that call, we're going to right click on that call, buy it back. Why are we doing that? Well, that's 92% of the maximum gain. Now, James, I don't hear you saying that we're going to roll the call. Does anybody know why we're not going to roll the call? Well, we're not going to roll the call because if you roll the caller is meant to be a bullish strategy. If we roll the call, it will make this position negative delta. That's never the intention. Okay? So the put itself has gotten so in the money, meaning the stock is so far below the strike, that what we're going to see in this case is we don't need to sell the call again. Not right now. Okay? Going to buy that back. And what we're going to do is confirm and send, note the commission, send the order. Well, now let's speak to something. Now, James, how much longer does that long put have? Answer, 17 days. James, if the stock closes below the 215, what's going to happen to the shares of stock? Can anyone answer that question? The stock closes in 17 days below that 215 long put strike. What should happen to the shares of stock? They're going to be sold. They should be sold because anything that's in the money could or should be exercised. Okay. So if we bought the put, that gives us the right to sell. Wait, if you have 100 shares and you sell 100 shares, that means you don't have any shares now. Now, one thing I want to kind of point out is when you go to the account statement, the first call we ever did was the 250 call, and we got $4.95 for it. We bought that back for 29 cents. The first call that we ever did, we made $470 on that Amazon call. $470. Then we sold the 245 call, and we bought that for 79 cents. We made another 270 there. And then on that last example, then we did the 230 call, sold that for $3.75. And then what you're now going to see is it's at 29 cents. So if we add it all up and say, well, how much is that? Good question. I'm going to find out. $470, $270, and what do we get there? 230, about $340. selling the calls realized a premium of about $1,080. What does that matter? Well, what you're now going to notice is if we said, well, how much have we really lost? Okay, so we're not counting this. Okay, not counting that. So if we take a look at kind of what do the calls offset that current loss, answer is about $1,080. So how much are we really down on this position? Answer, we're really down about $630. That if you were a stock investor only, you're still holding on, you're down, and you had 100 shares at that price, you're down 3,000. Guys and gals, if you could learn to cut your position, if you could learn to cut the losses in half, cut them by 2/3, cut them by a third, it's a lot easier to go back positive if you don't have big holes in the account of positions that really got hit hard. Now, I want to repeat this, okay? We're not going to roll that put. If that stock closed below that long put strike price, there's a really good chance that the trend has changed, okay? Let me repeat this. Why are we not rolling the call? Well, because when we do a caller strategy and we have 100 shares, the goal is to have about 20 or 30 delta anyway. Where are we? We're right now in the 20 delta. If we sell a call that has a 30 delta negative, you sell it, negative delta, it's going to make it where this position is probably about negative 10 delta. That's a bearish position. A caller position with shares is not meant to be bearish. Okay? So we're not applying another call. Okay? Now let me just tell you something. And I'm not disrespecting anyone. I'm not disrespecting. I have a lot of experience with callers. Okay? Callers are interesting because a lot of you and us, maybe, you buy shares, you buy a share of a collection of stocks. Some investors might say, well, why would I ever maybe consider a caller? Maybe if I don't want to do options just in general. They would consider a married put and a caller because they're trying to protect their capital. It's not a speculation trade. It's really about protecting capital and also trying to create income from selling the call to reduce the theoretical average price of what they own the position for. So if we have that position for, let's say, 230, and we subtract $1,080 or $10.80, theoretically, we've actually pushed down the break-even price if you take the entry price of the stock there, where the 1080 come from. This came from the covered call money. And now when we look at break-even, the break-even is $219.20. So what's easier to do if it bounces back to the upside? Is it harder to get to 230 or is it easier to get to 219.20? People probably say 219.20. So the reason why they would consider the caller strategy is, I'm defining my risk to the downside, but also theoretically lowering the average price in which they own the instrument by. Okay? That's what's kind of nice is all options are not the same. But the married put and the caller are definitely something that maybe an investor might consider and further want to kind of have some knowledge and understanding on. Okay? And some of us know how you feel, okay, about that. Now, what I want to do is see if there's any questions, okay? Now, by the way, one thing I want to kind of really just make sure that we understand, and I want to kind of show you just an example, okay? One of the main things about callers that people never maybe connect the dots is the counterbalancing nature of a caller. So when you sell that call, and this is a major point, a lot of times how many of you have ever done a covered call and the stock goes down and you said, man, seems like the more it went down, the worse it got. Well, that's true because the short call delta became less and less and you had a higher and higher delta. And I've shown this diagram a lot, but I'll just speak to it. But if you look at the caller, the delta on the caller is going to tend to stay more counterbalanced. And why is that? Well, it's on the short call, you have a delta of negative 30 to 40, okay? And if the stock actually goes down, the delta drops. SC for short call. The long put, okay, has also a negative delta of in our example, negative 30 to 40, okay? Now, if the stock actually goes down, where does the delta tend to go? Tends to go up. So when I say counterbalancing nature, yeah, the short call delta is dropping and the long put delta is rising. Who cares? Don't say those words. Because the biggest thing is so instead of when the market drops and drops and drops, it makes it so painful. I know how it feels, okay? You used to be that person. But the biggest actually thing is the delta stays the same. So why does it matter? Well, because if the stock goes down $1, instead of losing 100, we're down 21. Stock goes down $2, we're now down 21 times 2. Stock goes down $3, it's 21 times 3. And so literally we're losing at a fraction of what a stock investor is losing. That's why some people like those positions. Now, someone said, James, is a collar better or a married put better? Similarities, but you're going to see the collar actually has the premium from the call to help pay all for the put, okay? So there's some differences there, okay? But there's a lot of people that say, James, I just like collars, okay? Because they like to have the premium from the call. Now, are there any questions with that? Now, guys and gals, I'm telling you, I've taught collars for 20 plus years, and this is not an area that you want to be a lightweight in. I don't care if you said I'd never trade it real, but it's something you want to intellectually understand. And you want to understand the married put, because when that volatility goes up, I think just always counting on exits on stocks, you're going to kind of miss the opportunity to maybe learn how to use options as a way to protect. That's fine if you don't choose it to trade real, but you might say, hey, I'm going to practice it so that way I could see, is it something I would consider only under circumstances, maybe perhaps, when the volatility is low and starting to rise. Now, I want to kind of speak to just a couple positions, at least kind of show some stocks here. So first thing, when we look at the SPX, the first trade we did here today is on the SPX. We did a short put vertical. Keep an eye on look at the stochastics. I don't care if you use a 7.3 or a 14.3 setting. Keep an eye on the stochastics on the S&P and on the VIX, okay? Second, I want us to also keep an eye on, when you look at a couple of these positions, and I'm going to bring up, let's say, Pepsi, okay? We know that, for example, that some of these stocks, they've been going down, but then some of them are starting to reverse to the upside. Let's say you've never done a position like this, and you said, I'm going to buy the shares. I've done that before, but I don't want it. I want to kind of be protective. And that's fine. That's what we said the goal is at first. The goal is not to see how much money we can make. The goal is, how do you protect capital? How do you protect confidence, which is almost sometimes just as important as capital? Now, step one that we're going to do is we're going to buy the shares of the stock. We're going to buy 100 shares, okay? Now, at the minimum, we would need 70 shares. We could talk about why. But what I'm going to now do is going to go single order, first triggers SEQ. Now, this is going to be your homework assignment. I want you to go out and find some stocks that are bucking the trend of what we see in the market. I want you to look at some puts. We're going to use the 21 March expiration, okay? We could even go a little bit further out, 20 to 50 days expiration. And your homework assignment, I want you to look to practice buying some shares, okay, which you're probably already familiar with, but then accompany those shares with buying the put, okay? So notice what we did there. We did first triggers SEQ, there. Then what we did over here on the right-hand side, on the put side, we're going to go down and we're going to use this strike that has a delta of 30 to 40. Now, just remember this. When we say a delta of 30 to 40, we're just saying the probability of the stock being below that strike by a penny, okay? And we're also saying the change in the option price over the change in the stock price, okay? Two ways to look at it. We're going to click on this. And last but not least, before we close out, we're going to kind of put that order right in the middle here. Now, your homework assignment, don't tell me the dog ate your homework, okay? You don't even have a dog, okay? Jax ate my homework one time, but I did it anyway. Now, if you look at this, we just want to now, why are you choosing the March? Because I want us to speed up our learning, okay? So I want you to use in homework, the 21 March expiration, so that way you can see how these work. Your assignment is to do 3 of these. Buy shares and then buy puts. And then we're going to practice kind of how these play out, okay? Now remember, we kind of drew the numbers before and kind of talked about that. We're going to confirm and send. And now what you're going to see is this right here is a married put. Buying shares and buying a put at the same time. This is your first way to kind of understand how options can be beneficial for a stock investor, okay? Now this week we'll talk more about that, just like we did with the stochastics from yesterday. But that's what I want you to do for homework. 3 examples. And I want you to choose the 21 March expiration, okay? So I gave you a homework assignment there. Also to kind of note, if you said, hey, could I go back and really watch any of the prior classes? Absolutely. There's the link and there's the playlist. Also, quick reminder that you're going to see that right here, this is the Trader Talk channel right on YouTube. Feel free to actually check us out. And actually, if you're not subscribed already, just click right in the middle page, subscribe. Stay tuned for our next webcast coming up right at the top of the hour. And thank you, Barbara, for answering those questions in chat. Stay tuned for her class coming up later this afternoon as well. So remember, with what we discussed, it was done for example, illustrative purposes only. All investing involves risk, and we talked about that risk here today and how to define that. This has been the class on the Investor Master Series, and we'll continue this conversation this week as well. Take care. Bye-bye.